right, stocks basically unch going into the belly here. We got a little more than 7 minutes left. Joining me, Sonders, alongside Nate Peterson. Nate's the director of derivatives analysis, and Lizanne's the chief investment strategist. Afternoon, guys. So we got a holiday shortened week, but then we come back around. We got a little Fed speak. Lizanne, what do you think's moving the needle here right now?
Well, it depends on what part of the market you're talking about. Obviously, the concentration issue is still pretty acute, given how big a driver such a small handful of names and the significant underperformance outside. It's a rare instance where you've got at the index level a very overbought market, yet at the kind of average member internals level, you've got an oversold market. So I think it depends on what component of the market, but clearly the momentum is still up the cap spectrum.
This whole concentrated rally looked like maybe we were going to get a little splash of something different yesterday, and then we kind of drift back into it. But there have been some fits and starts. Lizanne, how come you think we haven't quite been able to really get that kind of broad-based participation? Like number of new highs still super low is one example.
I think down the cap spectrum, the real differentiator is what's going on in yields and where there's exposure. In fact, if you look not just the year to date, but over the past year and a half, within the Russell 2000, there's about a 20 percentage point spread between the zombie companies' performance, down about 10%, and the non-zombies companies' performance, up about 10%. So whereas moves in yields were directly correlated to what broad market averages were doing last year, it's become a little bit more nuanced this year, where moves up and down in yields either accrue to the disadvantage or advantage down the cap spectrum a little bit more than just the major cap weighted averages.
Okay. We were talking about this and what effect it has on vol. Was that Francis at the top of the show? It's pretty interesting, Nate, because if you kind of look at the surface, it looks like volatility is very low, but there's quite a bit underneath the surface. But look, on the surface is all that matters of the index as we keep grinding, and VIX stays pretty under control. So it seems like it's going to take something really big to kind of jostle us out of this complacency.
Yeah, don't fight the trend. Buying begets buying. Momentum begets momentum. If you look at even within technology outside of that, a lot of the year's winners, Costco, Chipotle, Elf Beauty, they're going towards those winners. And I think there's a reluctance to rotate. And to y'all's point that you were talking about earlier, with the rates coming down 20 basis points recently over the past couple of weeks here, you think biotech, you think solar would be benefiting, you think financials, small caps, and there's just that reluctance, I think, to go there. So the money continues to kind of chase after, a lot of the AI, a lot of the chip plays, mega cap tech. RSIs are hot, anywhere from 76 to 80 around here, but we know that's not a timing mechanism. And so, Oliver, from a near-term perspective, it's just, respect the trend and then be on the lookout for the best thing that I've got out there is some kind of a bearish reversal pattern. A near-term bearish reversal candle can give us some indication that, okay, we've hit a point where maybe there's a shift underway in this bullish momentum.
Shift, and if it does, the odds, I guess, are we have to either like melt up or have some kind of breakdown to get vol to move out of this. I mean, when you think about like the options for vol, Nate, is it like we slip back into single digits or go back to the highs of the year? What does that kind of look like if we actually shift out of this regime?
Well, first we're in summer, which typically you have the summer doldrums that comes into play. But actually, if you look at the VIX compared to the historical volatility, the actualized volatility day to day on the S&P 500, the VIX is overvalued. So it net benefits option sellers. And so if we do get some kind of a reversal there, you can look at callers. You can look at, if the VIX is going to stay between 12, 14 down here, that can make some sense to sell some calls potentially as well. But Oliver, it's not, we got down to 9-ish, I think, back in 05 and 06 on the VIX. So we're not there. And there does seem some reluctance when the VIX tries to, dip down and get an 11 handle, that it kind of creeps back up, which tells you maybe there's still some, respect out there in terms of 1 or 2 percentage points on the VIX in terms of the potential to get some kind of unknown.
Yeah, we've kind of got limits to the complacency as well when we do get down there. Lizanne, thinking about the data combined with the Fed speak this week after what we got on dots and Jerome Powell, how do you think that's factoring into the market right now?
Yeah, obviously, retail sales report today does point in the direction of maybe a September start and one or two cuts this year. But then you got today's data on industrial production that was a bit stronger. And I think in terms of expectations around the start point for the Fed and how many will be a function of incoming reports, I do think, though, that in terms of the Fed and the point at which they would have the green light to start easing policy may rest more on the labor market side of their mandate as opposed to the inflation side of their mandate, just because simply the math is not favorable to getting core PCE down to the Fed's target, if we're going to think in calendar year terms, by year end, which may put the onus on some weakness in the labor market to have the Fed look and say, okay, thumbs up for easing.
All right. And they're not ready to give it quite yet. It seemed like the language seemed to be really in line with what we saw from the dots. It seems like all the language people are like, I guess the August kind of gap helps a little bit, Lizanne. It kind of makes it easier on us. We're just like, look, we got September, December. It's not going to be July. Hang tight.
It's not going to be July. The dots, Powell's right to point out that that's not a policy prescription. That's a moment in time estimate on the part of individual members. What I found most interesting about the combination of the release of the dots as well as the summary of economic projections is the flattish expectation for the unemployment rate over the next couple of years. And history doesn't suggest that that's what you generally see. If you look at a long-term chart of the unemployment rate, once it inflects, it continues to move higher and vice versa on the way down. So this idea of just the unemployment rate bouncing around 4% for the next couple of years, I think that's a stretch.
All right. Great stuff. Thank you very much, team. I'm out for the week, so a good macro discussion to close it out for the session.